finance, a la shmup. What are the major classes of bonds? Well, there's world history, advanced trig, intro to growing a mustache, but of course, that's just for college-bound bonds who are trying to impress the top-tier universities. Well, in terms of bond classes in the real world, there are oh so many flavors to choose from. First, we've got senior obligation bonds, and these guys aren't cranky or gray-haired. They are the first type of bonds that a company would have to pay if they went bankrupt. They're often considered the most secure types of bonds for just that reason, so they pay less interest. Duh. Then there are junior obligation bonds, which are slightly less secure than senior bonds, so they have to pay a little bit more rent on the money. If a company declares bankruptcy, the juniors are paid after the seniors. Duh. Sophomores, freshmen, get behind them. Asset-backed bonds are a different thing, and they're backed by the assets a company has. For example, an airline might guarantee its bonds via the airplanes it owns, if it owns them. All right, moving on. Then we have debentures, which are backed only by the credit worthiness of the company. So basically, the company is just handing you an IOU and promising to pay you back with a handshake. Trust us. Yeah, sure. So debentures have to pay even more interest. And if the company messes up and can't pay you back, well, too bad, cupcake. The only comfort you would have in that situation is that the company's credit would be wrecked forever if they couldn't pay their debentures or other forms of bonds. It'd be the end of the CEO's career and pretty much all the management and so on. So they would really hate to go bankrupt, with a debenture, And that all might be cold comfort to you, though, especially if your investments were the ones wiped out by them not paying their debentures, and well, then you can't pay your utility bill. All right, moving on. Convertible bonds. Hallelujah. Like their name suggests, can be converted, usually into common stock at a given price at a given time period. You can make a tidy profit converting bonds into stocks if a company suddenly starts to do well and stock prices really increase. Like if you had a $1,000 par bond convertible into 20 shares of stock, well, when the stock's only at $10, that's not very attractive. But if that stock went to $50, it'd be like break even. If it went to $100, well, the bond converts and you double your money there. See how that works? There's the math. All right, well, finally, there are zero coupon bonds, which don't pay you anything until the very end. You buy them at a big discount, like $612, and then they pay par $1,000 like 10 years later. Once they reach maturity, they pay back what you invested plus all the interest that is built up in one chunk. Think high school dating. The problem is that some companies have a hard time paying back all these payments at once, and you get no interest payment along the way with a zero coupon bond, so they tend to pay even more interest, which is good for the person lending the money, assuming that they actually get paid back their interest and principal at the end of the zero coupon, right? Well, some companies set up special funds, like bond sinking fund equivalent, so that, they have enough money at the end to pay back their bonds once those bonds reach maturity. Unlike the writers here at Shmup, the maturity thing will never happen.